In this lecture, we're going to discuss why the aggregate demand curve slopes downward. So you'll recall that when we talked about market demand, we said the reason why the demand curve sloped downward was because of the inverse relationship between the price of the good and the quantity that was going to be demanded, which we defined as the law of demand. Now you'll notice that the aggregate demand curve slopes downward just like the market demand curve that we learned about in chapter 3, but it actually slopes downward for completely different reasons. It does not slope downward because of the law of demand. It slopes downward because of what we call price level effects. And so when the overall price level in the economy changes, that's what's going to cause movement along our aggregate demand curve. The three primary price level effects that give us the downward slope would be what we call the wealth effect, or sometimes called the real balance effect, the interest rate effect, or the international trade effect. So let's discuss each one of these individually. So the first price level effect, again, is what we call the wealth effect, sometimes called the real balance effect. And this focuses on the fact that what we're really concerned with when it comes to our financial assets is not the financial asset itself, but the purchasing power of that financial household. So in other words, individuals, households, businesses, and society have different levels of money, stocks, bonds, other financial assets. And what we're ultimately concerned with is how many goods and services can we buy with those financial assets. So how much goods could a dollar buy you? And when there's a change in the price level in the economy, what it does is change the purchasing power of those financial assets that we have. And when the purchasing power of our financial assets changes, that will alter the consumption that's going to take place in the economy, which ultimately changes the aggregate expenditures. In other words, we're buying more or less goods and services depending on what's happening to the price level. So just to simplify it, let's say, for example, that you currently have $1 and you want to use that dollar to buy a candy bar. If the current price of the candy bar is also $1, we can clearly see that the purchasing power of your dollar will buy you one candy bar. Now let's say, for example, that the price level changes. Now instead of a candy bar being $1, and let's make it an extreme example, let's say a candy bar now costs $2. In other words, the price level has doubled. There's been an inflation rate of 100%. Well, we can clearly see that now that $1 could only buy you half of a candy bar. So the amount of goods and services that you're purchasing is going to go down simply because the price level changed. In other words, you still have the same dollar, but because the price level increased, the purchasing power of the dollar went down. Instead of being able to buy $1, you can only buy, instead of being able to buy one candy bar, you can only buy half of a candy bar now. And then we can look at it going the other way. In other words, let's say you still have that same dollar, but let's say the price level decreased. Let's say the price of a candy bar is now only 50 cents. Well, now if the price level is dropping, then that means the purchasing power of your dollar has increased. Now instead of only buying one candy bar, you can actually buy two candy bars. And so again, if you're looking at the downward slope of the aggregate demand curve, we can clearly relate that simplified example to the aggregate demand curve. You can have three different price levels, and what we see is as the price level goes down, so all the way down here at P1, that increases the purchasing power of our financial assets, which is why the amount of goods that we purchase is higher than, let's say, when the price level is up here. If the price level was all the way up here at P3, then the purchasing power of our financial assets declines, which is why we would only purchase goods and services over here. So again, all we need to understand in terms of the wealth effect is the fact that when the price level in the economy changes, it alters the purchasing power of our financial assets, which is why the aggregate expenditures are going to either increase or decrease. The second price level effect is what we call the interest rate effect. And generally when price levels rise, what's going to happen is the interest rate is going to increase. And the reason for that is, again, because there's a decrease in the purchasing power of money. So for example, let's say that you normally need $100 to buy your groceries for the week. If the price level increases, then you're going to need more money to buy that same basket of groceries that you normally buy. And so generally what we believe is that if you need more money to purchase the same amount of goods and services, then you're going to have to sell off some of your financial assets in order to acquire that additional money that's necessary. One of the main theories that we use to explain this is that you'll see more bonds that are sold in the market to acquire money when the rise in prices occurs. And when there's more bonds in the market, that actually will cause interest rates overall to rise. And we know that interest rates are negatively related to investment expenditures. So in other words, if interest rates are going up, we're going to see investment levels fall, which will generally cause aggregate expenditures to fall. So in other words, we'd be moving up along the aggregate demand curve because of the decrease in investment expenditures. And then of course the opposite will happen if there's a fall in the price level. If the price level goes down, then we know that the purchasing power of our money increases, so we need less money to buy the same quantity of goods and services. And so the idea is that that additional money that households or businesses now have can be used to actually invest and buy bonds. And if we're buying bonds, then that's going to cause the interest rate to fall, which ultimately causes investment to rise and aggregate expenditures to rise. So basically just what you need to understand when it comes to the interest rate effect is that if price levels rise, it causes interest rates to increase, and if interest rates are increasing, aggregate expenditures are going to fall. And then of course vice versa. If the price level is falling, that's going to cause interest rates to fall also. And if interest rates are falling, that will actually cause aggregate expenditures to rise. But again, we're looking at it from the same perspective that we did in terms of the wealth effect. You have a downward aggregate demand curve, and of course, when the price level changes, it alters our aggregate expenditures as a whole. So again, we can have two different price levels going on in the economy. And notice that if the price level is dropping from P2 to P1, so the price level is falling, like I said, that means that the purchasing power of your money is increasing. So you don't need as much money to purchase your market basket of goods. And so because you'll have additional money that you can save, that additional saved money can be used to buy bonds. And so buying those bonds, taking them off the market, is going to cause interest rates to fall, which is the reason that aggregate expenditures is going to rise. All right, and then the third price level effect is the international trade effect, sometimes called the open economy effect. And this has to do with our price levels in relation to the price levels of our trading partners, and how when our prices change, it alters the domestic price relative to the foreign price. And so it will ultimately impact our net exports, which will cause a change in aggregate expenditures. So again, we start off with the same downward sloping aggregate demand curve, and we can see how when there's a change in our price level relative to our trading partners, that again alters our net exports. So let's say, for example, that our price levels go up. Let's say we started here at P1, but price levels went up here to P2. Well, if our price levels are now more expensive relative to our trading partners, that's going to impact our net exports. In other words, our goods are now more expensive, so we are going to export less goods and services. So if we're going to export less goods and services, then that means the value of our net exports is going to fall, which means aggregate expenditures would decline, which is exactly what we see here. We went from Y1 to Y2. Because our price level increased, we exported less goods. And then vice versa. Let's say, for example, initially our price level was at P2, but we went down to P1, so we moved down our aggregate demand curve like so. Well, now what that means now is that our goods are now relatively less expensive than our trading partners, so our net exports should rise because we'll be exporting more goods and services to our trading partners because they're going to demand more of our now cheaper goods. And so if we're exporting more goods, net exports is going to rise, and therefore we're going to see an increase in our aggregate expenditures. So just to sum up what we've covered in this lecture, we're just basically wanting to understand why our aggregate demand curve slopes downward like we see here. And again, the reason why it slopes downward is because of the three price level effects: the wealth effect, the international trade effect, and the interest rate effect are what give us the downward slope of the aggregate demand curve. So again, as the price level changes in the economy, that's going to alter the total aggregate expenditures on goods and services. So suppose I gave you a problem like this, and I asked you a decrease in the price level will result in what? Remember, if there's a decrease in the price level, then we're not talking about an actual change in aggregate demand. In other words, our curve would not be shifting. We're just going to be moving up and down our aggregate demand curve, because that's what a price level effect will do. It will only cause us to move along our aggregate demand curve, therefore altering our aggregate expenditures. So if the price level is going down, then the correct answer would be E, movement down the aggregate demand curve. And again, if you draw yourself a little graph, then you can clearly see that. We have our downward sloping aggregate demand curve, and if the price level is declining, then that means we're just moving down along our aggregate demand curve like so.